Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent licensed in all 50 states. So happy that you joined us today for a repeat guest, superstar, icon, Mount Rushmore, one of the four faces for financial people. Her name is Terry Savage. Terry, thank you so much for joining us once again. The fans are yearning to hear your take on things again.
I come back every time because just to hear whatever intro you're going to come up for. Well, nice being back with you again.
Well, I'm not scripted. People love that because, someone asked me the other day, who writes all your scripts for your videos and your podcasts? I'm like, scripts? Who's got scripts? We're just free-forming it. And what's good about when Terry and I get on these podcasts, it's literally a conversation. A lot of people just say, I love that because it's like you guys are sitting, drinking coffee and just talking. And, that's how we met. That's what we're doing now. And that's what this podcast is all about. Terry, just want to jump in. And I know you always turn the table on me and ask me questions as well, which is interesting. But I want, the people don't want to hear from me. They want to hear from Terry Savage about what's going on in the world at the time of this taping. We're in the first quarter of 2023. Things are a little chaotic, Miss Terry, but you've seen it all before. There's nothing new. What's your take right now?
Well, we're taping just in the third week of January. Mm-hmm. Well, we should just say January 25th. I had to look. It's anyways almost over. Mm-hmm. The market got off to a good start because there was a sense, every month there's a different outlook. Fed's going to raise rates too much. There's going to be a recession. As we come into January, maybe things will be okay and it'll be a soft landing. Right. So we had a pretty good start. Now we're having some down days because we're beginning to see some disappointing earnings. From companies like Microsoft and Boeing particularly, but other companies too. And there's a beginning to worry that maybe and a lot of layoffs, from companies people didn't expect to ever be laid off from big tech. That's the future of the world type of thing. And yet the stock market's rebounded. I think I just saw the Dow was within 6% of its all-time highs. I don't forecast markets. But what's really got things riled up right now is this debt ceiling. Mm-hmm. And boy, I have a few things to say about this. Number one, you put this on tape, and I've said this on the Chicago TV right here. We're not going to default on our debt. The U.S. is not going to default on its debt. Let's talk about this for just a minute. Our national debt is $31 trillion. It's a sum total of all the deficits over the years. Mm-hmm. This is so much politics. Now, look, it took the Republicans and the first 2 years of the Biden administration. Under Trump, we added $6 trillion to bring us up to about $30 trillion in national debt. And then the Biden, I can't even remember the titles of these, Fixing Inflation Forever Act and the Secure Act, and all of those added more. And just remember what those went for. That went for unemployment benefits that were huge, and PPP and stimulus checks, all those stimulus checks. Where do you think they got the money? They borrowed it, okay? And a third of our national debt, our $31 trillion national debt, is owned by foreigners, particularly foreign central banks. We are not going to default. We're not going to destroy the dollar. World oil is priced in dollars. We are like the centerpiece of the whole global financial world. But what they are doing is playing brinkmanship. And we had this once before where they actually delayed payments to the military. That's so ridiculous. And when forget politics, but when the Republicans say cut, excuse me, number one, they were equally responsible. Democrats too for getting us there. Sure. Number two, where are they going to cut? The three largest categories of spending now are Social Security and Medicare. Defense spending. Who's going to go up there from either political party and say, I don't think this is going to happen. Oh, you wealthy people, we've already taxed 85% of your Social Security benefits, but you work, but now you earn too much or you have too much in assets, so we're not going to give you any. That's not going to fly. Look, they pass these omnibus spending bills that commit us to spending. They never read them. They're 20,000 pages. If they really want to get serious, look into the spending. Of course, a lot of it is their own pet projects, but do not play brinkmanship with A, the national debt. We are not going to default. B, payments to our military who are out there serving. And you don't want to cut spending when we have a maniac in North Korea and another one in Russia. I mean, really, and maybe China wants to take Taiwan. Yeah. This is not one market. So bottom line, stop the spending going forward. The debt ceiling is the refinancing of all the IOUs that we borrowed. And I'm going to give you one more. I've gotten more than one email and a call and a text from a friend of mine who should know better, who said, Terry, you got us all into treasury bills. 6-month T-bills now paying 4.8% on January 5th, okay? So much better than your bank CDs. So now everybody says, I own treasury bills, they're going to default. More people than I will tell you have said to me, so should I switch to CDs? And I go, oh my God, listen, stop. CDs are insured by the FDIC, Federal Deposit Insurance Corporation. That is the same government that's borrowing through the treasury bills.
Right.
I mean, come on, stop worrying about it. Idiot politicians, both sides. You should know better. This is insulting to America in the eyes of the world. Continue paying the debt you've accumulated.
Yeah.
Forward, don't spend more on crazy stuff, and stop this public. I mean, it's just fodder for television. That's all.
Oh, totally. Okay. And I tell people all the time that there's three products that protect your principal, don't charge a fee, and pay a guaranteed interest rate. Excuse me. And in order of safety, they are treasuries, CDs, and fixed rate annuities, also called MYGAs. In that order, that's your level of safety. F stands for federal, okay? You know, it's FDIC, but above that FDIC are the treasuries, because that's a direct obligation. And I tell people all the time, if you just want to peel off interest, those are your three products, period. End of story.
Yeah, and we'll say, well, but what if? But I won't let anyone say, but what if? What should I buy? Well, I'll give you two choices. I mean, because that's really the end of the world as we know. Gold has gone up a little bit from 1830 to about 1920 something. I mean, if the end of the world were coming, gold would be at $30,000 an ounce. But then what would you spend the gold on? So maybe instead of that, what you should do is, just have a closet full of Campbell's soup. And I don't even want to joke about it, but your
I always
wife.
Tell people, if the conspiracy theories come true, we're both have houses in Florida and other places, but Florida, we're in Publix, the supermarket, fighting for bread. If that all happens, then we're punching each other for bread. And it's not the good bread, it's the bad loaf bread, the white bread, the bunny bread, and we're fighting for it. Yeah. So I really wish people would stop going down the rabbit hole. Exactly. Stop watching opinion television as much as you are doing, either channels, I don't care, and think rationally about all of this. And that's the reason I love having you on, because you bring decades of rational thinking to the party.
Well, that's why I love being on your show, because if we were sitting having a cup of coffee or a glass of wine, we would be saying this, and we would be saying, so how do we tell people? Well, we're telling you.
We are telling you. We're telling you with decades of experience. It's not going to happen. They're not going to default.
Exactly. I mean, there are some weird things that could happen in the universe, like an asteroid could hit the planet, and Putin could be serious about nuclear. I mean, let's just live our daily lives.
There's no strategy for that. There's no financial strategies for nuclear war, meteors hitting the earth, complete chaos, anarchy. There's no financial strategy for it. And even if you had the financial strategy, even if you shorted the markets perfectly and there's anarchy, what are you going to do?
What are you going to do with it? Yeah, you get all the money, and then well, now what? Do I go buy?
Tell me. I always love asking people like you, and there's like 3 on the planet, about crypto, because people have gotten hurt. The people that shouldn't be losing money or even going all in on crypto are all in on crypto. We know those demographics. So it's bouncing all around. have you given that more thought? Is that clarified a little bit more for you on where we're headed? Obviously, we both like blockchain technology, but that's not what we're talking about. We're talking about crypto.
Yes. So whenever anybody now, well, let's have some full disclosure here, by the way. I serve and have served for 20 years on the board of CME Group, Chicago Mercantile Exchange.
Yep.
And we list futures.
Sure.
In Bitcoin, we list crypto futures. That said, it's always been clear to me. I mean, maybe I was going to be wrong and miss something fabulous, but I've said, we made the standard disclaimers you just did. Blockchain is the wave of the future. That's the way the world's. I mean, we still have horses, but now only rich people have horses. But and everybody drives a car. So there will be blockchain. Crypto was when I think the last time we talked about people getting 20% on lending crypto. I mean, it was so obvious to me at the time, and I said it. If you want to be a speculator, you can speculate on soybean futures. I mean, will there be rain? How much will the farmers grow? What will the fertilizer cost? You can, if you want to go, you spend some time in Las Vegas. Let me ask you this.
I'm in Vegas now.
Okay, so what's your game of choice? Do you go to the casinos?
I don't. I bet on myself. I bet on my businesses. So that's my bet.
There was a time when I really understood how to shoot craps. Jimmy the Greek stood behind me and taught me how to shoot craps. And that's
nice.
Appropriate. I mean, the odds, and when you back it up and what you back it up with and all that stuff. And then someone said, you're on TV telling people to be sensible. I said, yeah, well, to me, it was a mental game, but I won't do that anymore. So it's been years. But in the realm of crypto, I think I put it in the category of, do you play blackjack? Do you play poker? Where you have or do you shoot craps where the house always has the edge,
Sure.
But where you can have some intellectual prowess. It's like playing backgammon. We play backgammon a lot around here. And if you know the numbers, it's not just a game of what the dice roll. I mean, there's some skill to it. So I can't say that a crapshoot is just a wild thing, but I think Bitcoin today is not an investment. It's more like a crapshoot.
Yeah, and I just watched. There's a new documentary out on Bernie Madoff, which is very fascinating because they kind of went through the whole thing and some stories that I didn't know on how it all happened. But the Sam Bankman-Fried, innocent till proven guilty. Let's go on record for that with the whole FTX scandal. That might be the craziest thing I've ever heard, Terry, on just the lack of transparency and the lack of oversight with billions and billions and billions of dollars of a kid, let's say it, a kid in shorts and a t-shirt in the Bahamas with no board of directors. I've got a board of directors, the annuity man. This guy didn't have a board of directors or an accounting firm. How's that possible?
That kind of stuff can happen. How's it possible that major firms, from the pension funds in Toronto to major venture capitalists, could put the money in? I want to give credit where it's due, and there's plenty of stuff on the internet. Chairman of CME, Terry Duffy, went to Congress and in effect said this. He literally called out what was going on and the political contributions and the money that was around by this made up money. There's a lot of scary stuff in Washington, but that's another scary aspect. Everybody, have you read the book Extraordinary Popular Delusions and the Madness of Crowds? That's must reading before you ever invest.
I agree with that.
Classic, written 100 years ago. It talks about the tulip bubble, the mania that people can get caught up in, and you must read that book to understand how sensible people can get caught up in something.
Large investment banks that didn't do the due diligence, basic due diligence, was incredible to me. And I'm assuming those people got fired. I don't know.
Yeah, there was Wirecard, which was a big European fraudulent thing that accounting firms never dug deeper into the initial fraud. These things come along, and that was one.
And there'll be another one. When Madoff's thing happened, people said that's never going to happen again. And I said, oh no, it'll happen within the next 10 years. We'll have another one. It's everyone trying to cut corners. You can't cut corners when you get healthy and lose weight. You can't cut corners when you're investing your money. And yes, there are stories, one out of a million stories that hit the wire that mess things up. But legitimately and rationally, if it sounds too good to be true, whether it's, I don't care what it is. No exceptions, period. And the whole Bitcoin thing, I forget I said the word Bitcoin, the whole crypto thing, which there's 7,000 crypto coins or whatever and counting. People just have to be rational. I think what worries me, Terry, is I read a stat that the younger people that are investing in crypto trust crypto more than they trust the S&P 500. That's a stat. That's tough. That's a hard one for old dudes like me to swallow.
Extraordinary popular delusions, or the old savage truth. The lessons that cost the most teach the most.
Nice.
I guarantee a lot of lessons have been learned.
Yeah, I always say, the scars are what we learn from, and some of these scars are tough. I just feel for the people, 65% of all Americans have what, $400 in their checking account, which dovetails into my next topic with you, which is inflation. I did a video recently that my PR firm changed the title, but the title was originally "Stop Bitching About Inflation." And then they changed it to "Complaining" because they didn't like my Southernism. But my point to people, and most of the people listening to this, you probably have money and are of means, and this time period for inflation is customized and personal, and you're going to get through it. So please stop going down the rabbit hole. With that being said, what is your take on inflation and how people should approach it?
That's so funny, because when you brought that, we do not plan these topics. I have no idea what Stan will
throw. No, we're free forming it.
The topic of inflation, I was going to say, that is so 2022. It's passe. Look,
exactly.
We're grown-ups. You cannot find my gray hairs. I spent a lot of money to make sure of that, but these are
I just wear hats. It's easy.
Okay. But we lived through the early 1980s. I mean, really seriously, we survived. I remember I'm telling my mom, you are not buying a 30-year treasury at 13% because inflation could go to 20% and be banana. You don't want to have 13% for only 20 years or whatever it was at the time. We got through that. I think the Fed has gained a lot of credibility. I know that the markets believe it. Otherwise, I said you'd have gold at $25,000 an ounce instead of $1,900 an ounce. And the only thing, the only possible way it could get out of hand now is if the Fed had to capitulate to save the dollar in some weird scenario. And I just don't see that happening. So the fact is, hey, you've got some money, what I call chicken money. You, for the last 6 or 8 months, have been putting it in T-bills. Currently, speaking 4.8%, a little over. And if you buy them at treasurydirect.gov, there's a whole article, how to buy T-bills, at my terrysavage.com on the right side under links.
By the way, that's Terry Savage, all one word, TerrySavage.com. Please go there and pin it.
I sell nothing. I endorse nothing. I have no clients. I am totally fiduciary. I write a syndicated column. I'm on radio and TV in Chicago and have a podcast.
She's a financial rock star, straight up.
No, we're taping soon. So about annuities, which I'm going to get to in a minute. So at any rate, thank you very much. But the point is, you have some money. Here's what we know. Number one, you cannot beat inflation, but you can adjust and get closest with treasury bills. Number two, there has never been a 20-year period. This is Morningstar Ibbotson history research, not a pep talk. There's never been a 20-year period where you lost money in a diversified portfolio of large company American stocks with dividends reinvested, just shorthand, S&P 500.
Sure.
No 20-year period where you've lost money, even adjusted for inflation. So you have a long time to retirement. A portion of your money is invested in the stock market, diversified, sheltered so that your dividends are reinvested and you're not paying taxes. That's your IRA. And you own your home, which now prices are still up over a year ago. That's slackening, but we're not having a financial crisis like 2008 where your home will decline. You're listening to this podcast. You are in the sweet position. You're probably not buried in credit card debt, which is now people who are trapped are paying like 25%, 28%.
And that's the 65% of the people we just discussed that have $400 in their checking account. They're maxing out. Those are the people that are getting hammered. Hammered.
Yes, you unfortunately on this podcast. They listen to me on radio and TV. I am preparing every year. I have a theme. 2 years ago, actually in January of before the pandemic, my theme was 21. This is a time to take some money off the table in stocks. Last year, my theme in January was refinance your house right now. You're getting 3%, 3.3% a year ago.
Right.
Never see rates this low again in your life. Okay. And my theme for this year, and I started hammering on it in December because people who read my newspaper columns and watch me on, general TV in the morning news and so forth, I might help them. Get out of debt. Get out of your credit card debt. There are still jobs. Take an extra job. Pay off the balance. Soon the economy will slow. You may not get an extra job. You're going to get trapped in debt. So I think by the end of this year, I'm going to be talking about consumer bankruptcies again.
Yeah.
I'm going to be about National Foundation for Credit Counseling, 800-388-2227. It's at terrysavage.com to get independent financial credit advice. Trust. I think even if we don't go into a bad recession, but look at the leading indicators, look at manufacturing, it's kind of looking like it might be a little more serious, even though there's still a demand for workers. I think we're going to see people whose balance sheets are strained, particularly seniors, who are only living on Social Security and have fixed incomes, and everything costs them more. So my theme for this year is beware of debt. And now, because you are the people who are watching Stan, and you're going, oh yeah, I know that. Here's a responsibility. Go talk to your kids, anybody over 30. Who's having dinner out at all those expensive restaurants, which I get to.
It's the kids. It's my kids.
It's exactly. They're not saving, talk to anyone you can around you, because there's a generation that's never seen job losses, or who thought they were immune to job losses because they were the tech, because they could do social media that was going to pay them forever to tell what they like, I mean, that in itself was a bubble. And I just talk to someone who doesn't know. If you're nodding your head saying, yeah, we know all this.
And to get on my patriotic soapbox here a little bit, when we go through these time periods in the country where you see layoffs and you see things happening, like two things happen. Number one, companies get more efficient, and they start realizing actually what the head count they actually need. Number two, when you're laid off, a lot of people are going to become entrepreneurs, which is also a good thing for this country. So it's going, the negatives turn into positives for this country. It's kind of like when COVID's made us stronger as a country. It was a crappy time and there were some bad mistakes made, but I think we can all agree we're stronger because of it. We understand it. We learned. We're not going to make the same mistakes again. And companies do the same thing. They overhire, they overpay, and then they reel it back, realize that they can do it with less people. And the people that are laid off realize that they can compete with the company that just fired them. And that's the true beauty of capitalism, true beauty. And so I think this is just a temporary time. And for all the people out there that say, Stan, you just don't understand inflation. Listen, I do. I think it's personal. Like for me, I have daughters that are this week turning 26 and 24. They're out of the house. I'm not taking them to dance. I'm not buying milk. It's different, okay? Everybody's inflation situation is different. And when people call me with large amounts of money, and large is relative, and I say, well, is it affecting your lifestyle? Well, no, it's not affecting my lifestyle yet. I'm like, well, then why are you complaining? You're going to be okay. I think everybody probably listening to this, you're going to be okay. Does it make us mad that eggs are $8 a dozen? Yeah, sure. It sure does. Buy the eggs, buy the drug.
But you're not talking now. I forget what the number is. Fully a third of seniors who get Social Security it is 99% of their income.
Correct. That is correct.
So if you happen to be tuning in, we are not dissing the impact of inflation. You got a little bump up in your Social Security check. Yep. It was offset by your Medicare premium rising probably. And the price of eggs does matter.
It does to those people, but
that's why we are concerned about inflation as a society. And that's why you got Powell saying, I am not letting this get away from me. I am not going to be pressured to finance, to put more money in. He's actually sucking money out, raising rates. The era of free money is over.
Yeah.
That impacts corporations, but there is no doubt. And for better or for worse, there were a lot of programs that were put in 2021, credits refundable. I mean, just actually giveaways to families, which were significant amounts of money, $350 a month for each young child. That's been reeled back in also as the end of that act. And so there are a lot of people who are suddenly finding that stuff costs more and they have less money. The good news is that for those who can go out and work, there are jobs. But again, a lot of people are not in a position to do that.
And I'm one of the employers that will hire as many people that are qualified that walk through the door. I'll hire them all.
Hey, hire them all to do what?
We have multiple offices, but for us is to handle all of our client needs, handle our client applications and things like that. We cannot find enough qualified people that want to work to fill all the positions that I need. And I know I'm not, and I talk to other entrepreneurs out there in other sectors. It's the same thing. I'm not sure what's going on in the country right now, but the work ethic is not where we need it to be.
Wait, 42 people. I hear them. I see you out there. I can feel you out there. I said, wait, what's that job? And do you have to come into the office?
The answer is yes, you do have to come into the office. I also think that the days of deciding if you want to come in or not are over, and they need to be over because, as you know, and you've worked in offices before, Terry, there's a synergy that's positive, not only for a business, but also personally and culturally that help. And, when we came out of COVID and got this big office in Las Vegas, and it's already filled and we're getting more space, to watch the interactions and the laughing and the stories and the going out after, that's what it's all about. We're human.
What are they doing in your office? Tell me specifically. And then I have some annuity.
I'd rather, my competitors would love to know exactly what they're doing, but let's just say that we are at the forefront of disrupting an industry and doing things in a pro-consumer way that by the end of the first quarter, you'll see changes with us that are going to be unique. And we're the leader out here anyway, but we're doing some things, and I'm ramping it up so that
I'm doing another podcast where I only interview you.
That's fine. And we'll go through the site and everything. But I'm putting my money where my mouth is because, a lot of my legacy employees were like, why are we changing? Why are we going to change when everything seems like it's working? And my answer to that is the American answer, is because we always strive to get better and we always strive to do things in a more pro-consumer way. And I have this drive within me to make the annuity industry a respected place. And for people that say they hate all annuities, they will be laughed at soon, because that's insane to say that. If you say that, that means you hate Social Security. If you say that, that means you hate CDs. So if you're saying I hate all annuities, and there are people that use it as marketing tools that I know and I have nothing against them, but you're going to be laughed at eventually, because with the demographic tidal wave of 11,000 baby boomers, people are looking for guarantees and income so they can go into chapter 2 of their lives and live the life that they deserve and have earned. And the annuity industry, I'm dragging them across the finish line to get the message in front of people to say, these are good products. You can't say I hate all annuities. There's many different types. It's like saying I hate all restaurants. So, my thing now is the legacy. The legacy I want to leave is that he changed the industry. and he changed people's feelings about contractual guarantees. And I'm going to do that. And then I'm excited about it. And that's the reason I'm ramping up and hiring as many people as possible. And we probably already have the biggest staff of any single, annuity agent in the country, and it's going to get bigger. And I'm bringing in some of the top consultants in the world to figure out how to make the consumer experience to purchase annuities unique, different, and easy. How about that?
What a tease you are. What a tease. Now, wait, folks, seriously, I mean, I knew Stan was up to something because he's in Las Vegas in this big office. Wait, what are you talking? I'm just 20 questions.
Sure.
Are you talking about immediate annuities?
Everything, every single type.
Are you talking about index annuities and variable annuities?
We don't sell variable annuities just because and I have nothing against variable annuities other than my take on it, and I'm probably wrong, and people can argue with me, is if you want to buy mutual funds, go buy mutual funds.
Yeah,
okay, that's my opinion. But with indexed annuities, yes, we sell them, but we sell them properly as a CD product with attached guarantees for lifetime income. We do not ever talk about them ever getting market type returns or bonuses or things like that. So, we sell contractual guarantees. So all of the fixed annuities that are out there, QLEX, DIAs, SPIAs, MIGAs, traditional index, those type of products, as I've always said, these are commodity products, and we're going to commoditize them and make the customer experience a lot better. Now, with that being said, since October 1st, Terry, the first MIGA came out, fixed rate annuity, for those people that want to know what a MIGA is, multi-year guarantee annuity. It came out in October 1st, the first one over 5% guaranteed yield. Okay. Ever since that time, Terry, it's like the dog has caught the car. And for clients of mine that have gone through the process, it's like pushing a rope with a lot of these carriers, and they can't hire enough people. The money is flowing in. And I always tell people, just because the Fed raises rates doesn't mean annuity rates are going to go linear and raise with them, just because if they're getting enough money in, there's no incentive for them to raise rates. So
insurance companies, right?
Yeah, the insurance company. So it's been a tough 3 months for the industry, just because of the overwhelming demand, and these companies are reaching capacity. And it's frustrating on our end because we can't get it done quick enough for our clients. It's frustrating on the carriers' end because they can't issue the policies fast enough, because I'm envisioning, Terry, these companies with like a warehouse full of FedEx packages. I know that's not true, but that's what I'm envisioning, because so many people want 5%.
Wait, stop for a second. I think here's what you're saying. Nobody wanted to buy multi-year guaranteed annuity that paid 2 or 3%.
Correct.
Why do the stock market, and the odds are you're going to come out ahead over it. But
right.
We're saying that just this fall was the Fed raised rates, and I know I got to, because I have all these contacts in the industry, and I all the emails. 5% guaranteed. You sure you don't want to do this? So we're talking about a multi-year guaranteed annuity, nothing with the stock market, and I think it's the industry's version of a CD.
Correct.
Of 5%. Now, to do that, you have to believe that inflation's not going to 10% or 11 or 12 or 13. That we're not.
Or you have to be rational enough to know that there's no way to hit that number, and you try to just get as much as you can. Right. My comment to this is, and I tell people this all the time, and I've been on with Morgan Stanley and Dean Witter, Payne, wherever UBS. I've been there. I worked on Wall Street. I know that side of the market. But they'll build a statue of you beside the bull on Wall Street if you average 7% every single year, year after year after year. There'll be a statue of you. Well, right now, at the time of this taping, and I'm sure this is going to change, but you can get 5.5, 5.6 on, say, a 5-year duration. Well, do you want to put your money at risk to get the 7? Or do you want to lock in the 5.5? Or do you want to do it smartly, do maybe a combination of the two? That being said, that's the reason the carriers are completely overwhelmed. But they're catching up, and we're seeing the light at the end of the tunnel with them. But boy, it has been, and I told all the carriers earlier, I said, listen, when you guys finally go to 5%, you better hire people quickly. And, obviously they couldn't. And so here we are.
So you are letting people know via this podcast in your new office.
Sure.
That can get a multi-year guaranteed well over 5% at the time of this moment.
Anything over a 3-year duration, you can get 5. 3 years and out. And I tell people all the time, and here's the way to look at MYGAs, CDs, and treasuries. If your duration is less than 3 years, buy CDs and treasuries all day long. If your duration that you want to lock in is more than 3 years, they're MYGAs. It's really that simple, because people say, well, you talk about CDs and treasuries and you don't sell them. I'm like, yeah, but I love them. 3 years and in, 3 years and in, treasuries and CDs, 3 years and out, multi-year guarantee annuities. And that way you are locking in the highest contractual yield possible for the durations that you choose.
Now stop. I'm just looking right now as we take. The 5-year treasury is yielding 3.58%.
Okay.
Insurance companies are giving you like 2 full percentage points more than that, a guarantee for 5 years.
Sure.
12 people out there are saying, excuse me, but I mean, how do they do that?
Let me tell you how they do that. It's very simple.
How do they do that? How, I mean, will they go under? I mean,
no. Look, just think rationally about who issues an annuity. It's a life insurance company, okay? And life insurance companies have many things they price off of. They sell life insurance. They know when you're going to die, so that's a profitable product. They sell lifetime income stream products like SPIAs, VIAs, and QLEX. That's a lifetime income stream. They know when you're going to die. That's a profitable product. They have legacy bond portfolios, Jimmy Carter bonds and Barack Obama bonds that are non-callable, that are very good. Then they look at the capacity of what they want to raise and what they know they can guarantee, and then they glance at the Fed. So those are kind of 5 legs of the pricing stool, whereas a bank is just looking at the Fed, okay, in essence. The life insurance company has all kinds of pricing mechanisms that they're trying to do. And as a broad sense, when a life insurance company issues a MYGA at 5%, what they're really saying to you is, we know with all of the things that we offer that we're going to make 5.5%. Okay, we're going to give you 5, and we're going to keep 50 basis points on billions of dollars. It's that simple. And I always tell people, annuity companies have the big, life insurance companies have the big buildings for a reason, because they know when we're going to die. Property and casualty companies go out of business because they don't know when the hurricane's going to hit. So life insurance companies know, and they know. And other people say, well, last time the Fed raised, you saw so many of these MYGA companies lower their rates. Why? Is because they've reached capacity, they reached the amount of money they want to raise for that tranche, and then they lower the rates to not attract money. It's a very interesting sector to watch because it's not linear to the Fed.
That's fascinating. Now, are you telling me that, and because I did start reading this stuff, major insurance, we're not talking about little dippity-doo insurance companies with BBB ratings.
No.
Major insurance companies are today offering that kind of yield, but that when, in fact, that at some point they'll be filled up.
And then they'll lower their rates. They'll lower their rates so they won't attract the money.
Is there, now, okay, you get a 5-year, I'm going to ask all the consumer finance. 5 years guaranteed at 5.3.
Whatever. 5.5, 5.6, and some MYGAs allow you to take out interest on a monthly basis. Some do not. We offer all of them, so you just have to tell me the liquidity that you want.
And are they AAA rated?
Some are, some aren't. But the way that I look at this, Terry, and I was quoted in Barron's a couple of weeks ago. They talked to me about MYGAs, and I said, with MYGAs, we're dating them, not marrying them. Okay, so when we're doing, in my Southernisms, we're looking at the claims paying ability of the duration. Okay, so can that A or A- rated company back it up for 3 years? The answer is yes, because we're not going to be there after 3 years. Now, if we're going to buy, if we're going to buy a lifetime income product, we're marrying them. So it's got to be quality paper, A+ or better.
People are asking this question. I'm very good with ESP for what the audience wants to know. So at the end of 5 years, there's 3 possibilities. Interest rates are 2%, inflation has been slain, and your 5-year period ends. Or, oh my God, we've had runaway inflation. I guess those are the possibilities.
Sure.
What happens, 2 questions. What happens at the end? And B, as you were talking about, some allow withdrawals of interest. But let me do this. Let's do the end first. What happens at the end of 5 years?
You have the choice is, I want to get all of my money back. Please send it to me. Or if it's IRA money, I want you to send all of that money back to the original IRA source, or let's roll it to another MYGA and kick the tax can down the road. Or one of my most popular videos is called MYGA to SPIA. We take the MYGA proceeds, shot for the highest immediate annuity rates, and do a non-taxable event transfer to that immediate annuity. And what have I done? I've stripped out all fees for a lifetime income product. So, you know, if you buy an index annuity with an income rider or a variable annuity with an income rider, nothing wrong with those. We sell the income riders. You're paying a fee for the life of the policy. If you want to strip all of that out and know what your guarantee is going to be in the duration as you're deferring, buy a MYGA, no fees, and then move it to an immediate annuity, no fees. It's a very efficient way to do future income. Now, okay. I'm not sure the carriers like it because they don't get those annual fees, but it's pro-consumer.
Yeah, okay. I got that. We all got that, right? Didn't we? All right, yep. Now, it's Mrs. Smith. She thought she could tie it up for 5 years, but an emergency came up. What do you do with your MYGA if it's 3 years in?
Well,
or Joe, the smart guy, who's really annoyed that he only got 5.5% because if, you know, something happened to Powell and inflation in the world, and now inflation's 14%, and he's tied up for 2 more years.
For the duration, there are surrender charges. Now, what has to happen on our end, which does, is there has to be a suitable and appropriate amount of money placed in the MYGA and sufficient amounts of cash and or money market left on the table so that they don't have to disrupt that contract. Now, I always tell people, do you want to take out interest or have the ability to? Some of these will allow you to take out 10% every year penalty free, you know, if you need liquidity. But I think that is more of an advice problem. People, I always tell people, don't put too much money in annuities, okay? You know, why is this turning this? I didn't want this to turn into an annuity thing. Come on, Terry. One more question. You get one more annuity question, then I pivot back to you.
I want to give you one more, but everybody, this is going to turn into a column. You'll read it in your local newspaper, go to staff.com. Within 10 days, it'll be posted there. Okay, I have one more question for you there.
Okay.
Annuities. Okay, turn into my show, guys.
I know.
I do a podcast called Friends Talk Money, and we are interviewing Stan. It's Pam Kruger of Wealth Ramp and Richard Eisenberg of PBS Next Avenue. And we're going to do that. But I just one more totally different annuity question since people tune in for annuities. Okay. Years ago, with all the fees involved, okay, someone put $100,000 in an equity linked index, name annuity. It was expensive. It was whatever it was. It wasn't the full equity links. You never got the dividends. All the reasons Stan.
Well, let me stop right there. And if you buy an indexed annuity, a fixed index annuity, and you don't attach an income rider, there are no fees.
Okay, but what happened was a lot of people bought these products, and the index wasn't the S&P 500, including dividends. And over the long run, dividends account for about 40%. Is a fact.
Actually, isn't it like 50%? The dividend in the dividend, 40%. It's 40 now. Okay.
Total return of the S&P. But whatever it was. It might not have been the greatest index. You might have not gotten all you could. You fell for there's no downside, but you get the upside of the stock market.
No, you don't. That's where I got to stop. You don't.
Okay, well, that's my question. Okay, so somehow you have something called an investment account in here, and you put $100,000 in. We had a pretty good bull market, and we're still up within 5-6% of the all-time highs. And you did this.
Yeah, but you're making the classic mistake of comparing it to an investment.
I know. I'm just teeing you up correctly. There are a lot of people who now look at this statement and say, great, now I'm 67 or 8. And that 100,000 in my investment account is now $218,512. And they want to pick up the phone and call the insurance company and say,
all right,
well, my investment account grew to 218,000. Please send me a check.
All right.
Yeah, withhold taxes if you want.
Let me just explain it very visually for people. It's very simple. You know, index annuities are based, the returns are based, limited returns are based on a call option. Terry has written the book on call options. So the point is, it doesn't include dividends. It's a snapshot of price, either a 1-year option, 2-year option, 3-year option, whatever. Now, if you add an income rider to that, or a death benefit rider, that's two separate calculations. The income rider value, which is fictitiously sold as yield, so you'll see an agent at a bad chicken dinner seminar say you can get 7% yield. What they're talking about is an income rider, which is a phantom account. You can only use it for income. But whatever that index side grew by, okay, you can get that out lump sum and do whatever you want to with it. It's just not going to be, historically, since they were introduced in 1995, they've been CD type returns because they were introduced for CD type returns. The other thing people need to understand is that these index options, and there's three levers that control and limit the upside, which is caps, spreads, and participation rates. Very complex. If you want to, I've written a book on it. You can, I'll write it to you, but it's so complex that the annuity company can change the rules at their discretion on those index options. I'll give you a great example, and let's close with this and pivot back to you. If you bought a 10-year surrender charge index annuity with a 1-year call option, meaning it's going to renew every single year, in essence, what you've bought is a 1-year guarantee with a 10-year surrender charge. The other 9 years, you're at the discretion of the annuity company to change how they limit the upside.
You change the index,
and they can change the way they limit it. So back to you. Enough about that stuff.
I know my head spins. You know what I do when people call me? I say, call. I do. Go look at TerrySavage.com. I answer readers' questions all the time.
All I'm going to tell people is don't buy the dream. You're going to be pitched the dream. Don't buy the dream, because the contractual realities will show up.
All right. Now your focus is on these multi-year guaranteed annuities, and they're paying right now.
Right. Well, my focus is what people need. I ask two questions. It's very simple. What do you want the money to contractually do? When do you want those contractual guarantees to start? With the acronym PIL that explains annuities in general: principal protection, income for life, legacy, and long-term care. If you don't need to contractually solve for one or more of those items in the PIL, you don't need an annuity. Notice there's no G for growth. But back to you. You're one of the few people.
Ladies and gentlemen, I give you Stan the annuity man.
Thank you very much.
Really, if you only got 60% of that, you're with me. But I always remember PIL.
I've done around 800 videos so far. We keep doing them, and a couple hundred podcasts. But I was going to ask you, one of the few people that have literally met most of the recent Fed chairpersons. You actually have met them, know them. You think they're doing a pretty good job, and do you think they're still going to buck the trend and keep raising rates? And I know you're not a prognosticator, but what's your gut feel tell you?
Well, we're still here, aren't we? They've all, ever since Arthur Burns. Got to think about that.
Arthur Burns, man.
Yeah, well, I never met Arthur Burns, but I remember him. I'm a student of his.
But you've met most of them.
Yeah, I have a videotape of me walking down a hallway asking Paul Volcker about interest rates, and him at 6'8" and me toddling along in my high heels. And he said, "You really know these numbers, don't you?" Yeah, one of my great moments. The Fed chairmen have done a very good job. We have not been overwhelmed by inflation. Now, I do not claim to know any of them, or that they would know me, but Jay Powell came to a speech, gave a dinner speech at something I was invited to in Chicago years ago, when, believe it or not, T-bill rates were like at 0.08%.
Right.
And in Europe, all the 80% of the investment grade bonds were negative bonds, and banks were paying negative interest rates. In other words, you paid them in Europe for the sake of putting your money in their bank. So it was negative. And out of those questions, I turned into Terry, the TV person, and I said, "Mr. everybody's being polite." I said, "Excuse me, well, is there a possibility, because we're right on the brink, that interest rates could go negative in the United States?" It was just a journalist kind of question.
Sure.
And I'll never forget Jay Powell, with his glasses down on his nose, looked at me over the top with his eyebrows and said, "Interest rates will never go negative in the United States." And he's literally sort of intimidated me, scared me. And he is a man, going back to then, not just what I see on TV now, is a man of great resolve. So I think that he's going to fight. I'm sure he's going to fight the good fight. The question is mostly been, will it be overkill? Will they go 25 basis points? Will it be enough? But I think what you're seeing in the stock market is not so much fear of inflation, but knowledge that the economy is slowing. We just got too many signals, except for unemployment.
Yeah.
signals that the economy is slowing and that earnings might come down. So it's causing the stock market a little bit of bangs. I put the odds of runaway inflation in the stratosphere. I believe as long as Powell is there, and despite this debt crisis, that they will stick to their guns. That's the only way to believe.
All right, Miss Savage, I tell you, this has been great. Obviously, I love having you on. We've kind of come up against the hour, but what I want to do, as I always do with you, so, is the mic drop moment where you get to wow us with a final thought, and then I'll close us out. So I'm going to count us down to mic drop moment from Terry Savage, financial superstar.
I think I've used this mic drop moment before,
yeah,
but it's
you have, but you got to come up with something else. So 5, 4, 3, 2, 1, mic drop moment, go.
I'll take the Buffett mic drop moment. Nobody ever got rich betting against America. We've been through a lot of horrible stuff. I mean, the longer you're around, the more horrible financial stuff, aside from everything else. This is the greatest, best place in the world. That's why the dollar remains strong. It's why foreign central banks invest their reserves here. They're not investing them in Russia or in the euro. And here's the mic drop moment. Both sides of the aisle write to someone and say, stop being an idiot. I don't care, both sides of the aisle. It's our government. Go today. I think there's still a website called contactingthecongress.com, or just Google your representative's or senator's office. It doesn't have to be articulate. You don't have to say what you want them to do. You don't have to argue about spending. Just say, stop acting like an idiot and playing brinkmanship with the U.S. credit. Do that. If everyone listening did that immediately, it would told everybody else to do it, would go a long way. That's my mic.
This is a dovetail into, since you quoted Warren Buffett, I'm going to quote him that dovetails into our business model. Rule number 1, Warren Buffett says, never lose money. Rule number 2, never forget rule number 1. And that is Fun with Annuities, Terry. Thank you so much. And thanks to everyone listening on all the major podcast platforms and the Fun with Annuities YouTube channel to see how wonderful Terry looks. And we will see you next time.